Welcome to the AI Research Roundup. I'm Alex. Today we're looking at a paper from the Hugging Face trending list, published on October 2nd, 2025, just yesterday. The main punchline is a new benchmark that tests whether large language model agents can actually trade over months in live-like markets, revealing that most fail to beat buy and hold, while a few manage slightly better returns with lower risk. The paper is titled StockBench: Can LLM Agents Trade Stocks Profitably in Real-World Markets? And as we'll see later, the implications for agent evaluation are quite significant. In short, this paper offers a contamination-free, multi-month setup with daily prices, fundamentals, and news, and it scores agents by cumulative return, maximum drawdown, and the Sortino ratio. So, Table 1 makes the case that StockBench uniquely satisfies the core needs for evaluating trading agents. The table shows that it combines market simulation, a multi-month horizon, and continuous decisions, while also being contamination-free, which means the test period is temporally separated from any model training data. Competing benchmarks generally miss two or more of these elements, so they cannot reflect real trading value reliably. So, while Table 1 argued for a realistic testbed, Figure 2 shows how the investment targets spread across major sectors to keep trading decisions balanced. The wheel highlights technology, finance, industry and manufacturing, consumer goods and retail, and medical care and health. This fixed, yet diverse set from the Dow Jones Industrial Average stabilizes results because stock picks stay representative rather than cherry-picked. The design supports reproducibility across runs. Alright, Figure 1 shows the full StockBench setup, which links real market data to a step-by-step agent workflow. The left side presents a back-trading environment, meaning a historical simulation that only reveals information available at each decision time. The right side outlines 4 stages from portfolio overview to execution and validation, so actions become concrete trades. This structure makes results reproducible, while staying close to real trading conditions. Well, Figure 1 showed the workflow. Table 2 reports who actually performs in trading. It ranks models by a composite z-score, which means the 3 metrics are standardized and averaged. Kimi K2 tops the list with a return around 1.9%. Quen 3235B Instruct and GLM 4.5 follow closely with strong drawdown control. The passive baseline trails with a return of 0.4%, so several agents provided modest gains. Table 2 reported who performed overall. Figure 4 shows how rankings shift between a downturn and an upturn, which reveals regime sensitivity. The left side places the passive baseline near the top during the slump, while most agents sit below. On the right, the rankings flip as GPT OSS 120B rises to the lead and several agents surpass the baseline. The crossover paths suggest that model strengths depend on market direction, so stable performance needs explicit regime awareness. So while Figure 4 highlighted regime sensitivity, Table 4 shows how information sources drive profitability. An ablation study means the authors remove parts of the input to see their impact on outcomes. Kimi K2 records 1.9% with full inputs. The same model drops to 1.4% without news. It falls to 0.6% without both news and fundamentals. GPT OSS 120B posts minus 1.2% with full inputs and declines to minus 3.4% when both are removed. Wrapping up, 2 takeaways stand out. Large language model agents rarely beat buy and hold, but a few deliver small gains with better drawdown control, and success depends on market regime and rich inputs like news and fundamentals. The broader implication is clear. Evaluations must be dynamic, and agents need explicit risk and regime awareness. That is it for the AI Research Roundup. I am Alex. Thanks for listening.